The world produces more wealth today than at any point in human history. Factories operate at full capacity, technology amplifies productivity, and international trade moves billions of dollars worth of goods every day. Yet, despite this abundance, global debt continues to grow at record-breaking speeds. Trillions of dollars are added annually. And most people instinctively feel the strain in their own lives. Rising living costs, stagnant wages, and endless bills. The paradox is striking. How can a planet that produces more than ever before also owe more than ever before? The answer lies not in scarcity, but in the hidden mechanics of modern money. At the heart of this paradox is the method by which money is created. In modern economies, the majority of money is not printed as cash or backed by tangible assets. Instead, money is largely created as debt. Every government bond, every bank loan, every corporate credit line introduces new money into the system, but it does so with an obligation attached. Interest. Money is not neutral. Every unit carries a claim on future labor. This means that even as production increases, obligations increase faster. Wealth is being generated, yes, but the system ensures that obligations multiply in tandem. Consider the role of central banks. Institutions like the Federal Reserve, the European Central Bank, and others are tasked with regulating money supply and stabilizing economies. They wield immense power, controlling interest rates, liquidity, and the cost of borrowing. Yet this control is a double-edged sword. By managing low interest rates and facilitating cheap borrowing, they encourage governments, corporations, and individuals to accumulate more debt. When money is cheap, borrowing is attractive. Governments fund infrastructure projects or social programs. Corporations finance expansion. Households take on mortgages and loans. All this borrowing increases total debt faster than the economy can produce value, reinforcing the paradox. The process is deceptively simple. Debt is used to create money. Money is spent into the economy, and interest accumulates, ensuring that more borrowing is necessary in the future. This is sometimes called the debt-driven growth cycle. On paper, the economy appears to be expanding. GDP rises, stock markets climb, and businesses grow. But the invisible layer underneath is accumulation of obligations. The world produces more goods, services, and technological innovations. Yet these achievements serve as collateral for more borrowing rather than a path to financial liberation. History shows that this pattern is not new. The early 20th century, after the creation of the Federal Reserve in 1913, government debt began to rise rapidly. Wars, infrastructure spending, and social programs were financed largely through borrowed money. Even as the country's industrial output and productivity soared, debt levels ballooned. Interest payments and financial obligations accumulated alongside real economic growth. By the time the Great Depression hit, the financial system was already heavily leveraged. Productivity alone could not prevent economic collapse because debt obligations had grown faster than production. This cycle is global, not just local. Across Europe, Asia, and emerging economies, debt has consistently outpaced growth. Countries continue to borrow to finance budgets, fund projects, and service existing debt. Even when economies produce surpluses, the surplus is often insufficient to cover interest payments on previously accumulated debt. In effect, growth feeds the system that creates the need for more borrowing. Economic expansion, rather than providing freedom from debt, becomes a mechanism to generate even more obligations. Interest is the engine that drives this process. When new money is created as debt, it comes with a mandatory cost. $100 is borrowed, repayment may require $105,110, or even more. Even if the economy doubles its output, the total obligation can still exceed production. This ensures a cycle of perpetual borrowing. Governments, corporations, and individuals are compelled to keep taking on new debt to meet prior commitments. Debt becomes self-reinforcing. Productivity cannot eliminate it. Only additional borrowing can temporarily manage it. This explains why, despite record productivity and technological advances, average citizens often feel financially constrained. The system redistributes gains from labor and production upward. Large institutions and financial markets are typically the first to receive newly created money, invest, speculate, and profit before prices rise for ordinary goods. Inflation then follows, eroding the purchasing power of wages. Workers see their cost of living increase while their nominal earnings remain stagnant. The more productive the economy becomes, the more ordinary people must work just to maintain their standard of living. Central banks exacerbate the problem through policy. Quantitative easing, a tool widely used after the 2008 financial crisis, involves creating new money to buy government bonds and other financial assets. While the stated goal is economic stabilization, the immediate effect is to inject money into financial institutions and markets. Those at the top benefit first, often significantly. While ordinary citizens experience slower adjustments in wages and prices, this is the Cantillon Effect, an economic principle that demonstrates how the first recipients of new money gain disproportionately, while late recipients bear the cost. Productivity may rise, but its rewards are unevenly distributed. Debt normalization is another hidden driver. Modern societies treat debt as not only acceptable, but necessary. Mortgages, student loans, auto loans, and credit lines are introduced early in life. Young adults are socialized to accept debt as a normal part of achieving financial independence. This embeds dependency into the economy. Labor is pre-committed to future obligations. Even when the economy produces more, the benefits of productivity are funneled first into servicing debt. The result is a system where citizens' labor primarily sustains financial obligations rather than increasing personal wealth. The historical consequences of this structure are evident in recurring crises. Financial collapses, recessions, and inflationary periods often coincide with peaks in global debt. When obligations outpace productive capacity, defaults occur. Governments intervene with bailouts, new borrowing, and monetary expansion, temporarily relieving pressure, but ensuring that debt continues to grow. Each cycle reinforces the same underlying pattern. Productivity rises, debt rises faster, and ordinary citizens are compelled to work harder to keep pace. Global statistics illustrate the magnitude. As of the 2020s, total global debt including government, corporate, and household debt exceeds $300 trillion. Meanwhile, global GDP is roughly $100 trillion. Even as productivity surges with technological innovation, the ratio of debt to production continues to climb. Growth alone cannot reduce obligations. It only fuels the next layer of borrowing. In essence, the world is trapped in a system where increasing output generates more obligations rather than eliminating them. One of the most striking elements of this system is its invisibility. Citizens see prices, wages, and debts, but the mechanisms of money creation remain largely hidden. Central banking policies, interest rate adjustments, and quantitative easing are often complex, opaque, and difficult to understand. Ordinary workers contribute to economic growth daily, but rarely grasp how their labor indirectly sustains the accumulation of global debt. Productivity and output are divorced from financial independence. Economic growth exists within a framework that ensures obligations always outpace production. This structural reality also affects social dynamics. As debt grows faster than production, inequality widens. Those who own assets benefit from financialization, rising property values, stock market gains, and bond returns. Those who rely on wages experience stagnation, despite working in increasingly productive environments. Economic output is not the same as prosperity for all. The system channels gains toward financial actors, while ordinary people remain tethered to obligations, reinforcing social and economic hierarchies. The paradox extends to innovation. Technological advances increase efficiency, reduce costs, and expand production capacity. Yet these gains rarely translate into reduced debt burdens for individuals or governments. Instead, innovations are monetized, leveraged, and used as collateral for additional borrowing. The more the world produces, the more opportunities arise for the system to generate new debt. Even in a world of abundant resources, the structure ensures perpetual financial obligation. Understanding this phenomenon changes how we interpret economic headlines. GDP growth, stock market rallies, and record-breaking productivity do not equate to financial freedom for citizens. On the contrary, these indicators often coincide with rising obligations. Debt becomes the lens through which production is valued. Ordinary workers may feel the rewards of technological progress indirectly, but most gains flow to those positioned to capture returns from debt-driven money creation. This structural debt cycle also explains why austerity and stimulus policies seem paradoxical. Governments may implement spending cuts to reduce deficits, yet total debt continues to grow because interest payments and new obligations exceed fiscal adjustments. Conversely, stimulus programs temporarily inject liquidity and boost production, but the added borrowing increases long-term obligations. In both cases, growth alone cannot resolve the imbalance between production and debt. The system is designed to perpetuate itself. Financial crises throughout history confirm the repeating pattern. The 1929 stock market crash, the 1970s stagflation, the 2008 global financial crisis, and even contemporary debt crises all illustrate the same structural dynamic. Productivity may surge before a crisis, but the combination of debt, interest, and systemic obligations ensures that growth alone cannot stabilize financial systems. Ordinary citizens bear the cost, often through unemployment, inflation, or austerity. While financial actors are cushioned or even benefit from bailouts and policy interventions, the implications are profound. It is not enough to produce more or work harder. Understanding the mechanics of money creation, debt accumulation, and central banking is essential to comprehend why obligations outpace output. Growth is not inherently liberating in a system structured around perpetual debt. The paradox of rising production alongside rising obligations is a deliberate feature of modern finance. It's not an accident of mismanagement. Ultimately, the takeaway is sobering. Global debt grows even when economies produce more because money is created as debt. Interest ensures perpetual obligation, and the first recipients of new money profit disproportionately. Production fuels the system, but does not dismantle it. Ordinary workers contribute to increasing output, yet the benefits are filtered upward through financial mechanisms. Economic expansion is intertwined with growing financial obligations, creating a cycle that is difficult to break. The final lesson is clear. Real financial stability is not a matter of producing more. It is a matter of understanding the hidden architecture of money. Debt-driven money creation ensures that growth will never fully liberate ordinary citizens from obligation. The world can produce more wealth than ever, yet the financial system is designed so that it must owe more. Until this structural reality is recognized, the paradox will persist, quietly shaping the labor lives and futures of billions around the globe.